In 36 hours, the sun rises on a new world. The holiday is over, the ban becomes law. While you were counting down to midnight with champagne, I was watching the Asian markets open. My wife thought I was crazy, sitting in the dark with my laptop at 11:47 p.m. on New Year's Eve. "It's a party downstairs," she said. I told her, "The real party is about to start in Shanghai." She rolled her eyes. But I knew something she didn't. I knew that January 2nd wasn't just another Thursday. It was the day the music stops. Tick-tock. Right now, at this exact moment, there are 3 prices for silver on planet Earth. Not 1, 3. And the gap between them is the sound of the global financial system cracking in half. Tier 1, Shanghai, $84 per ounce. The real price. The price where physical metal actually trades hands. Tier 2, real life, $79 per ounce. What your local coin shop is charging, what Samsung is paying, what Tesla can't ignore. Tier 3, the zombie price, $72 per ounce. The corpse on your screen, the lie CNBC is still selling. Now the ghost, you're looking at a ghost. Let me explain this like I'm explaining it to my neighbor who pumps gas. You know how sometimes the gas station across town is 12 cents cheaper per gallon? And you think, should I drive over there? But then you do the math. The gas you'd burn driving there, the time, the hassle. Sometimes it's worth it. Sometimes it's not. That's arbitrage. That's the game traders play every single day. They see a price difference between 2 markets and they close the gap. They buy low in one place, sell high in another. It's automatic. It's mechanical. It's supposed to work. Right now, silver is $12 cheaper in New York than it is in Shanghai. $12. That's not 12 cents on gas. That's a 17% spread. In normal times, every trader with a boat and a brain would be buying in NY and shipping to Shanghai. They'd print money until the gap closed. But here's the thing. The bridge is burned. A friend of mine works in logistics, container shipping. He explained something to me last week over coffee. He said, "John, when you're dealing with China and export bans, the deadline isn't just a date on paper, it's a guillotine. Once that date hits, it doesn't matter if your cargo's on the water. If it arrives after the ban, it gets turned around. You lose everything." So here's what happened. The arbitrage traders looked at that $12 gap. They did the math. Ship time from New York to Shanghai, 14 days minimum, more like 3 weeks if you hit weather or port delays. The ban takes effect in 36 hours. The math doesn't care about your feelings. They can't make it. Even if they loaded a ship right now, this second, it would arrive in China mid-January. After the gate closes, after the ban is law, the cargo would be rejected, turned away, worthless. So they're not even trying. And that's why the bridge is burned. New York is now an island of stranded paper promises, floating on a sea of real metal that's locked away on the other side of the world. Now let me take you inside the belly of the beast, the COMEX, the paper casino where silver trades as electrons on a screen. Most days, deliveries are boring, predictable, background noise. In a typical December session, you might see 60, 70, maybe 100 contracts stand for delivery. That means someone actually wants the metal, not just the bet. They're cashing out their chips. On December 30th, there were 69 delivery notices. That's 345,000 ounces. Normal, boring. 24 hours later, 1,847 contracts. 9.2 million ounces. That's not a spike. That's a stampede. Let me paint you a picture. You ever play musical chairs as a kid? I did. Birthday parties, school. The music plays, everyone circles the chairs, laughing, casual. Then the music stops. And in that split second, chaos. Everyone dives for a seat, elbows flying. Someone hits the floor. That's what this is. Except the chairs are silver bars, and the players aren't kids. They're banks, hedge funds, sovereign wealth funds, the big boys. And they just realize there aren't enough chairs. A 20-stick spike in deliveries isn't a coincidence. It's a bank run in slow motion. It's the smart money screaming, "Get me out of paper and into metal before this thing implodes." Here's what they know that you don't. Once China locks the export gate, the global supply chain fractures. Shanghai inventory disappears. London vaults get raided. And suddenly, those paper contracts in New York, the ones promising delivery whenever you want, become a game of hot potato. You don't want to be the last guy holding paper when the music stops. I went to my local coin shop yesterday. New Year's Day, they were actually open for a few hours. The owner, Mike, has been in the business for 30 years. Salt of the earth guy. Knows the market inside and out. I asked him, "Mike, what's your premium on Silver Eagles right now?" He laughed. Not a happy laugh. A tired laugh. "John, I can quote you a price, but I can't guarantee I can get them. My distributor just sent me an email. Limited availability, ghost inventory." You know what that means? I knew exactly what it meant. Ghost inventory is when the database says they have it, but when you try to buy it, suddenly there's a delay, a back order, an excuse. It means, Mike continued, that the big boys are hoarding. They're keeping metal in reserve for their VIP clients. Tesla, Samsung, the defense contractors. Guys like you and me, we're at the back of the line. This is what the real world looks like. Not the screen, not the chart. The real world is a coin shop owner who can't get inventory even though the price says silver is cheap. The scoreboard is broken. Now let's talk about something the mainstream media will never mention. The repo market. I know, eyes glazing over. What's a repo market, John? Let me make it simple. The repo market is where banks go when they need cash overnight. It's the ATM for bankers. They park some collateral, get some cash, pay it back the next day with interest. It's supposed to be boring, mechanical, invisible, except when it's not. You ever gone to an ATM and seen the temporarily out of service sign? I did, last summer, middle of a Saturday. Needed cash for a barbecue. 3 different ATMs, all down. That little flicker of panic. Is something wrong? Is my account okay? Then you find a 4th ATM, it works, and you forget about it. But what if they were all down? What if every ATM in town had that sign? In the last 48 hours, the Federal Reserve injected $5.8 billion into the repo market. Not a loan, not an investment, an injection, emergency liquidity, quiet money, the kind of money that doesn't show up on CNBC. Why? Because somewhere, somehow, a bank or several banks are bleeding cash. They're trying to cover their short positions in silver. They're trying to plug holes in a dam that's cracking. $5.8 billion is not loose change. We need to keep this thing from exploding before the markets open kind of number. I call this period the void. It's the space between the old world and the new world. It's the administrative time. And you know what? Administrative time is banker code for we are broke. Let's cross the ocean. Let's go where the real action is. Shanghai. The Shanghai Gold Exchange operates differently than COMEX. It's not a paper casino. It's a physical marketplace. When you buy silver on SGE, you get metal, real, tangible, deliverable metal. No games, no hypothecation, no trust us. And right now, Shanghai is a vacuum cleaner. In the last 2 trading sessions, just 2 days, the SGE drained 84 metric tons of silver from inventory. That's 2.7 million ounces. Gone, withdrawn, locked in vaults, secured behind the Great Wall before the export ban drops the hammer. Inventory levels are cratering. And here's the kicker. The price is rising, not falling, rising. Because in Shanghai, they understand something that Wall Street refuses to admit. If you don't hold it, you don't own it. China isn't playing the paper game anymore. They're playing the end game. They're securing atoms, physical atoms, before January the 2nd locks the gate. And when that gate closes, what do you think happens to the rest of the world? What happens when the largest silver consumer and refiner on the planet stops exporting? I'll tell you what happens. The illusion shatters. The paper price and the physical price stop pretending to be the same thing. The divorce is final. Now let's talk about the suits. The guys in boardrooms who don't care about Reddit threads or YouTube videos. The guys who care about one thing, keeping the assembly line running. Samsung just secured a 6-month forward supply of silver. Not 1 month, not spot market purchases, 6 months. They're locking in supply now because they can read the calendar. They know what happens on January 2nd. Tesla, same thing. They're not waiting for a dip. They're not calling their CFO and asking, should we wait for $28 silver? No, they're buying. Today, at $79. Because the alternative is halting production. And halting production costs more than overpaying for metal. This reminds me of March 2020. Remember? The toilet paper panic? The bottled water runs? Everyone suddenly realized that just-in-time inventory meant just in time to run out. I remember going to 3 different grocery stores, empty shelves, signs limiting purchases. And the crazy thing, there wasn't even a real shortage. It was a fear shortage, a panic shortage. But this is different. This isn't irrational panic. This is rational panic. Samsung and Tesla aren't idiots. They're not hoarding. Because they're scared. They're hoarding because they've done the math. They've seen the export ban. They've seen the Shanghai premium. They've seen the delivery spike. They know what's coming. Just in time is dead. Just in case is here. We're now in what I call the last train phase. This is the final window. The last few hours before the gate closes. Now, imagine you're at a train station. The last train to safety leaves at midnight. It's 11:30. Do you? A, wait to see if ticket prices drop. B, check Twitter for other people's opinions. C, get on the damn train. Right now, every sophisticated player, the banks, the funds, the industrials, they're choosing C. They're piling onto the train. And the train is the physical market, not paper, not promises, not derivatives. They're standing for delivery. They're withdrawing from vaults. They're paying premiums because they understand something fundamental. When the music stops, the chairs disappear. I keep thinking about this video game I used to play. Old school RPG. There was this glitch where the shopkeeper's prices would randomly drop to 1 gold instead of 1,000 gold. You could buy legendary weapons for pocket change, but the glitch only lasted a few minutes before the servers reset. If you didn't act fast, the window closed and prices went back to normal. The silver market right now is that glitch in reverse. The screen price is the glitch. 72, that's the bug. The real price, the Shanghai price, the physical price, the I need this metal for my factory price, that's $79.84 and climbing. The glitch is about to get patched. And when it does, the screen price will snap to reality like a rubber band that's been stretched too far. Here's what's going to happen to your brokerage screen over the next 36 hours. You're going to see red candles. You're going to see headlines like silver drops on profit taking or precious metals slide on strong dollar. Ignore them. Those red candles are ghosts. They're the death throes of the paper market. They're algorithms trying to defend a price that no longer exists in the real world. While the screen shows red, the vaults are emptying. While CNBC talks about a pullback, Samsung is locking in supply. While the analysts say silver is overbought, the comics delivery queue is exploding. The scoreboard is broken. I want you to do something for me. Go find a silver coin, a real one, an eagle, a maple leaf, whatever. Hold it in your hand. Feel the weight, feel the coldness, feel the texture. Now look at your screen. Look at that number. $72.18, red candle, down 2%. Ask yourself, which one is real? The metal in your hand or the number on the screen? I did this yesterday. Held a silver eagle in one hand, phone in the other, and I felt this weird disconnect. Like I was holding a $40 bill, but my phone was telling me it was worth $28. The cognitive dissonance was overwhelming. That dissonance? That's the market screaming at you. That's the signal breaking through the noise. My grandfather used to keep cash in a coffee can, buried in the backyard. He lived through the Depression, saw banks fail, saw people lose everything overnight. So he kept a rainy day fund, just in case. I used to think that was paranoid, old-fashioned. Then 2008 happened. Then 2020 happened. Then I started paying attention to the repo market. That $5.8 billion the Fed just injected? That's not a strategic reserve. That's not a planned allocation. That's a coffee can full of emergency cash being dumped into the system to keep the lights on. And here's the thing about emergency cash. You only use it when you're desperate, when the normal channels aren't working, when the machine is seizing up. Banks are supposed to have liquidity. They're supposed to have cash on hand. That's banking 101. If they're calling the Fed for a $5.8 billion bailout in 48 hours, that tells you everything you need to know about the stress in the system. They're not managing risk. They're managing survival. Let me paint you a picture of Friday morning, January 3rd, the first trading day after the ban. Shanghai opens. Physical silver, $80, maybe $92. Inventory, critical lows, premiums exploding. New York opens 4 hours later. Paper silver, $72. Unchanged, still asleep. And then the phone calls start. The margin calls, the force majeure declarations, the "we regret to inform you" emails. Due to unforeseen supply chain disruptions, delivery on your contract will be delayed. Translation: we don't have your metal. We never had your metal. It was always just a promise. And promises don't shine. The gap between paper and physical becomes undeniable. Comics scrambles, regulators scramble, CNBC scrambles to explain why silver is 72 on the screen but 0.85 if you actually want to buy it. This is what I call Silvergeddon. Not a crash, an awakening, a reality check. The moment when the market admits that paper and metal are two different things. And here's the beautiful part. You can't stop it. The Fed can't print silver bars. The comics can't conjure metal from thin air. China's export ban isn't negotiable. The math doesn't care about your feelings. So here we are, 36 hours, maybe less by the time you watch this. You have a choice to make, not a financial choice, a reality choice. Do you trust the screen or do you trust the vaults? Do you believe the paper price or do you believe Samsung's purchasing department? Do you think this time is different or do you think history rhymes? I can't make this choice for you. I'm not a financial advisor. I'm just a guy with a laptop, a calculator, and a really bad habit of watching Asian markets open on New Year's Eve. But I will tell you this. When the dust settles, there will be two groups of people. Those who secured physical metal before January 2nd, and those who trusted the screen. The era of paper silver ends tonight. The bridge is burned. The train is leaving. The chairs are disappearing. And when the sun rises on January 2nd, the world will look different. Not because anything magical happened, but because the lie can't hold anymore. The gap is too wide. The pressure is too great. The market is screaming. Are you listening? TikTok? This is not financial advice. This is a warning. The math is real. The countdown is real. The choice is yours. 36 hours, Choose wisely.